In 1719, France was the richest kingdom in Europe and completely broke. Its treasury was empty, its currency in free fall. And yet, within months, thousands of citizens were pouring their life savings into a new financial miracle: paper shares in a company that promised to pay off the entire national debt by mining gold in Louisiana. The man behind it all? A Scottish gambler, ex-convict, and economist named John Law. He didn't just create a company, he reinvented the French economy, issued new paper money, took over the national bank, became the de facto minister of finance without a title. And for a brief moment, it worked. Markets exploded, shares multiplied tenfold. The public believed they had discovered a new kind of wealth. But none of it was real. Behind the soaring stock prices, there were no ships, no gold, no profits. The Mississippi Company had become the most elaborate shell game in economic history. Then it collapsed, spectacularly. Fortunes were lost overnight. Riots broke out in Paris. France was pushed into a financial coma that would last for generations. And here's the catch: this wasn't a chaotic accident. It was the logical result of a system built on manufactured trust, centralized control, and artificial liquidity. Every piece was designed to delay collapse, until collapse was the only possible outcome. Sound familiar? When we trace the mechanics behind the Mississippi bubble, we're not just looking at a historical fraud. We're looking at the DNA of modern finance. The hidden levers behind speculative booms, the tools of central banks, the price of monetary illusion. In 1719, John Law printed the future, and the future printed him back. France, early 18th century, a kingdom of splendor, art, and war debt. The year is 1715. Louis XIV, the Sun King, has just died after 72 years on the throne. His funeral is grand, but behind the golden velvet lies economic ruin. Decades of war against Spain, Holland, the Holy Roman Empire have drained the treasury. The court at Versailles dazzled Europe, but every chandelier had a price. France's national debt stood at over 2 billion livres, an astronomical sum for the time. Servicing the debt consumed more than half the kingdom's annual income. And worse, the crown's borrowing power was exhausted. No one wanted to lend to a bankrupt monarch. The tax system was medieval and fragmented. Nobles were often exempt, while peasants were overburdened. Collection was outsourced to private tax farmers, who skimmed profits and inflated costs. Efficiency was low, corruption high. And France had no central bank, no unified currency, no formal credit market, just a patchwork of local mints, royal edicts, and coin shortages. Money moved slowly, unreliably. The financial system was paralyzed. Enter the regent, Philippe II, Duke of Orléans. As the new de facto ruler during the minority of young Louis XV, he faced an impossible dilemma: raise funds without sparking revolt, restructure debt without losing control, revive commerce without a modern banking system. This is when a curious proposal arrived from a foreigner. John Law, a Scottish financier with a flair for probability and a criminal record, had a bold idea. France, he argued, didn't lack wealth. It lacked liquidity. Its gold and silver were locked in vaults, stagnant. The solution? Replace metal with trust. Circulate credit. Stimulate trade. In essence, create money not from gold, but from belief. Law proposed the creation of a national bank that would issue paper money, backed not by coin, but by royal authority. It would unify France's fractured monetary landscape. More importantly, it would give the crown immediate access to credit, without new taxes or foreign loans. Some advisors were horrified, others intrigued, but France was desperate. And Law, despite being a foreigner, ex-convict, and self-taught economist, had one critical advantage. He understood what France's elite feared most: collapse. He promised revival, growth, stability. In 1716, with the regent's support, he founded the Banque Générale, a private bank, but with royal permission to issue paper notes. Within months, confidence began to grow. Trade picked up. Currency started to circulate again. The experiment looked promising, but law was just getting started. By 1717, he had set his eyes on a much larger prize, a colonial company with monopoly rights over France's American territories, especially the Mississippi Valley. Vast lands, largely unexplored, full of rumored riches. Gold, silver, tobacco, furs, it didn't matter. The promise was enough. He merged his bank with the new Compagnie d'Occident, then began to consolidate power, bought out other trading companies, absorbed the national mint, took over tax collection. By 1719, the entire financial apparatus of France was slowly concentrating in one man's hands. And the public? They believed, because for the first time in decades, the economy was moving. People were getting rich. The debts of the state seemed manageable. On paper, everything pointed up. But beneath the surface, law wasn't solving France's debt crisis. He was transferring it. He was replacing hard liabilities with speculative hope, coins with promises, taxes with stock sales. What looked like innovation was displacement, and France was drifting into a financial experiment unlike anything Europe had ever seen. If this gave you a new perspective, tell me where you're watching from. The pivot came in the summer of 1719. By then, John Law's Mississippi Company had absorbed not just trade monopolies, but the entire state's financial operations. It controlled the tobacco trade, the African slave trade, the mint, the tax farms, even the national debt. It was no longer a company. It was an engine, a financial organism fusing corporate ambition with royal authority. And then it mutated. In August 1719, Law launched a public subscription of new shares in the Mississippi Company. The nominal value, 500 livres per share. But demand was so frenzied that within weeks, secondary market prices had soared to 1,000, 2,000, 5,000 livres. By December, a single share was trading at 10,000 livres, a 20-fold increase in just a few months. What triggered this mania? Law offered buyers an irresistible package. Purchase shares on credit using government-issued banknotes. Then use the rising share value as collateral to buy even more shares. The more demand increased, the more money Law's bank printed to feed it. It was a closed loop. Shares created money, money bought shares. Rising prices justified more printing. Printing created more liquidity, which inflated prices further. And the public, watching neighbors get rich, poured in everything they had. It became a national obsession. Blacksmiths sold tools to buy stock. Farmers mortgaged land. Nobles sold ancestral estates. Parisian servants became millionaires on paper. The Rue Quincampoix, a narrow alley in Paris where shares were traded, turned into a human stock exchange. Fights broke out. Fortunes were made by lunch, lost by dinner. This wasn't merely a bubble. It was an institutionalized illusion. Behind the soaring Mississippi stock stood no gold mines, no colonial profits. The Louisiana Territory remained largely undeveloped. The riches were theoretical, projected into the future, while real money changed hands in the present. And Law knew it. He increased money supply by billions of livres. The Banque Royale, which had just been nationalized, became a printing press under royal decree. Inflation accelerated. Coinage disappeared from circulation. The paper livre lost touch with reality. But Law didn't back down. Instead, he doubled down. He issued more shares, more notes, more credit. He even offered to buy back government debt using inflated Mississippi stock, thereby anchoring public finance to speculative valuation. The entire national debt was being repackaged as equity in a fantasy. This is the moment the system inverted. What began as a strategy to revive commerce became a mechanism to avoid reckoning. The state wasn't solving its liabilities. It was pushing them into a speculative vacuum and calling it innovation. The consequences were predictable, but at the time, they felt impossible. To criticize Law was to oppose progress. To question the company was to question France itself. The bubble had become sacred. And that's the problem with illusions. They don't collapse when they're questioned. They collapse when they're believed too much. At the heart of the Mississippi bubble was a perfect feedback loop, elegant in design, fatal in execution. Let's break it down. John Law's system fused four elements: the state, a bank, a company, and paper money. Each fed the next. Each depended on belief. First, the Banque Générale, later renamed the Banque Royale, issued banknotes, paper currency redeemable for silver. These notes were meant to lubricate trade, provide liquidity, and boost confidence. So far, it resembled the beginnings of a modern central bank. But Law went further. He merged the bank with the Mississippi Company. Then, the company acquired monopoly rights to French colonial trade. Next, it absorbed the collection of taxes. Finally, Law used the company to absorb France's national debt, offering shares in exchange for government bonds. Now imagine this: a single entity that could print money, collect taxes, manage trade, issue shares, and restructure sovereign debt, all under one man's control. How did this mechanism work in practice? Step 1, the bank printed new paper money. Step 2, investors used that money to buy shares in the Mississippi Company. Step 3, the company's share price rose due to demand. Step 4, rising share prices attracted more investors, which justified printing even more money. And so the loop repeated. Each round of share issuance was oversubscribed. Investors often paid in installments, using banknotes whose value depended on the company's performance, a circular dependency. The shares were backed by colonial revenues that hadn't materialized. The money was backed by trust in shares that had no foundation. It was a financial machine designed to run on acceleration. But like any engine, it needed friction to slow it down, and there was none. No independent regulator, no monetary limit, no counterparty to say stop, and the scale was immense. Between 1719 and early 1720, Law's bank issued over 3 billion livres in paper money, roughly quadrupling the money supply in less than a year. Prices soared. Grain doubled, rents tripled, wages stagnated. Speculation swallowed commerce. The paper money was supposed to be redeemable for silver, but the silver was gone, hoarded, exported, or never there to begin with. Eventually, people began to test the system. Some tried to convert their paper notes back into coin. Others sold their shares to lock in profits. Confidence began to tremble. Law responded by imposing controls, limits on withdrawals, forced conversion of coins into notes, even bans on holding gold. It didn't work, because once redemption was restricted, the illusion of value cracked. The market realized that the money was not money. It was ink, supported by belief, but not by reserves. This is where the loop became a trap. The bank couldn't redeem the notes without triggering collapse. The company couldn't sustain its share price without new investors. The state couldn't pay its debts without Law's mechanism. Every component depended on the others surviving, and none could stand alone. And here's the twist. The Mississippi bubble wasn't just about greed or overconfidence. It was about the fusion of public power with speculative finance. The moment the state became a shareholder in its own illusion, the market stopped being a market. It became policy. The collapse came fast. In January 1720, John Law was at the height of his power, head of the Banque Royale, controller of the Mississippi Company, effectively the finance minister of France. His paper empire had reached its peak. Shares traded at 10,000 livres. Paris buzzed with easy fortunes. By May, it was over. It began with doubt. A few large investors tried to cash out. Gold and silver reserves, already thin, started to vanish. Law, desperate to maintain confidence, ordered limits on coin withdrawals. That only made people more anxious. Then he froze redemptions entirely. Banknotes could no longer be exchanged for metal. The promise was broken. Trust, the invisible engine, seized up. Panic followed. Crowds rushed to sell Mississippi shares. The price plummeted from 10,000 to 7,000, then 5,000, then 2,000 in weeks. Law tried to stabilize it by fixing prices through decree. He ordered the share value to remain at 9,000 livres, then 5,000, then 1,000. Markets do not obey decrees. Each time the state intervened, confidence eroded further. On the black market, shares traded far below official prices. Paper money lost purchasing power daily. Basic goods became unaffordable. Riots broke out in Paris. Shops closed. Soldiers were sent into the Rue Quincampoix to restore order. They couldn't. By late summer, the paper livre was worthless. Inflation had scorched the economy. Debtors rejoiced. Their obligations evaporated in real terms. But for creditors, savers, and fixed-income workers, the effect was catastrophic. Lifelong fortunes disappeared. Rents collapsed. Wages became meaningless. And the state? It was left holding a corpse. A dead company, a discredited currency, and a mountain of unpaid obligations. The Banque Royale was shut down. Mississippi shares were annulled. Debts were quietly restructured or simply forgotten. John Law, once hailed as a genius, fled Paris in disguise. He died in exile a few years later, penniless. France, meanwhile, entered a long financial winter. For decades, the crown avoided any major monetary innovation. Paper money became a symbol of betrayal. Public trust in the state's financial promises vanished. When the French Revolution erupted later in the century, the scars of 1720 were still fresh. The system had collapsed not because of theft, but because of belief without limits. The price of that belief was institutional paralysis. And here lies the deeper consequence. When a central power fuses with speculative capital and controls the monetary spigot, there is no market correction, only delayed collapse. Because the state cannot default publicly. It can only devalue, restrict, deny. Collapse happens off stage. What was the real cost? Not just lost money, but lost memory. The illusion worked long enough to bury accountability, and then it repeated. If you've seen shadows of this elsewhere, tell me where you're watching from. 3 centuries later, the language has changed, but the pattern hasn't. Then, paper notes backed by future profits from unproven colonies. Now, digital dollars backed by projections of infinite growth. Then, a national bank fused with a private company, issuing money and absorbing debt. Now, central banks purchasing assets from markets they're supposed to regulate. History didn't disappear. It just went silent. Let's strip it down. In the Mississippi bubble, law created liquidity by issuing paper. Investors used it to buy shares. Rising asset prices were seen as proof the system worked. The state grew dependent on that illusion until it cracked. Today, monetary policy follows a similar rhythm. Central banks, through quantitative easing, inject liquidity into the financial system, buying bonds, mortgage securities, sometimes even ETFs. This isn't debt cancellation. It's asset inflation. Money enters the system not through wages or productivity, but through balance sheets. The result? Stock markets rise, real estate surges, and risk gets repriced downward. Confidence returns, but it's synthetic. Like law, modern central banks assume that confidence is a controllable variable, that trust can be manufactured, that rising asset prices equal economic health. But behind those prices often lies a hollow core. When central banks backstop everything, from sovereign debt to private risk, markets stop being markets. Price discovery fades. Failure is deferred, not prevented. Consider this. In the aftermath of the 2008 crisis, and again in 2020, the Federal Reserve and the European Central Bank expanded their balance sheets by trillions. The Bank of Japan has become the largest shareholder in its own stock market. The People's Bank of China intervenes routinely to steer investor sentiment. They are no longer referees. They are players. And the public? They see the line go up. But wages stagnate, debt loads increase, asset ownership concentrates. Speculation becomes survival. Sound familiar? Then it was law's company absorbing the state. Now it's the state absorbing market risk. In both cases, liquidity became the illusion of solvency. The Mississippi bubble ended not because people were greedy, but because the logic of the system couldn't hold. When money creation depends on belief in future value, and that value is priced by confidence alone, there is no ceiling until there is no floor. What does that mean today? That the tools we use to stabilize can become engines of distortion, that monetary policy, once a brake, has become the gas pedal, that belief, once organic, is now engineered. And engineered belief has a cost, not always in inflation, sometimes in silence, in apathy, in the quiet concentration of risk. The real danger is not collapse. It's the conviction that collapse is impossible. John Law didn't invent the bubble. He merely gave it form, a form so precise, so mechanical, that it could be rebuilt again and again under new names. Each time the ingredients shift slightly, the company changes, the currency changes, the story changes, but the structure holds. Belief replaces substance. Instruments multiply. Debt becomes an asset. And somewhere a mechanism begins to loop, silently at first, until everyone is inside it. Then the loop accelerates. Then it breaks. And we call it a crisis. The Mississippi bubble didn't end in 1720. It was translated into credit booms, into housing manias, into sovereign debt spirals, into markets that cannot fall because the system itself is tied to their rise. What Law exposed, perhaps without intending to, is that money is never neutral. Once it enters the bloodstream of power, it becomes something else. A promise, a weapon, a mirror. And in that mirror, we see the same cycle unfold, always slightly modernized, always slightly faster, always slightly bigger. History doesn't repeat, it adapts.